VP and Fund Manager at ICICI Securities PMS. I mean, good to have you with us here. Thanks for your time. I mean, if you're watching the screen, it's the definition of a very nervous, jumpy kind of market. I mean, if you could kind of define the market as a collective and read what they're doing through the price action, it's jumpy. And maybe it is jumpy because of the kind of price gains we've seen, especially in PSU names. Absolutely, in some cases, I would say bizarre. I mean, very tough to explain. There are those where perhaps some of these gains are justified, and those where there's momentum at play, right? Gains beget gains. PFC, I think, is one of your largest holdings, Amit. Just talk about the PSU space and what you're seeing there. Are you seeing irrational exuberance in many pockets there? And then talk about PFC specifically.
Yeah. So you rightly mentioned, I mean, if you look at the last few months, non-PSU stocks have broadly underperformed the PSU index. So it is very important to understand, where this PSU index is taking us from here, because now the election, our election, US election, interest rate cuts, everything market is looking at from here onwards. And yes, it has also moved up. So when I look at the PSU index valuations and compare with the Nifty valuations, it used to be almost 31% discount from 2010 till 2016. And then it declined to 68% discount. Now it has recovered to 48%. But still, if it has to go to 31% discount of the initial period of the last decade, then another 32% of upside is possible. And that is where my sense is, these companies which are coming out, which had a long period of decision-making problem, which had a long period of cash flow problem, and the order book position, which is very sustainable now, if they are coming out, I think this 32% move can lead to many stocks performing in this particular bucket. You look at the mining companies now, for example, they are coming out after almost 10, 15 years of long lull period. And we have seen that Mr. Prime Minister, he called upon the Ministry of Minerals, and they were looking for critical minerals in the market, which are needed for India. And that is where India wanted to become Atmanirbhar. And that is where actually those mining companies are performing now. So my sense is this set of ideas will work still in the PSU space. And that is what we need to look at. So this is the exercise one needs to do going forward in the couple of years also.
Specifically, Amit, talk about PFC, which is your largest holding at about 8% of your portfolio. Now, the stock has gone up 300%. Explain how one justifies significant upside from current levels in terms of fundamentals, valuations. If someone buys PFC from here on, what should they expect? PFC or even REC?
Yeah, so PFC is the holding company, and we bought this stock around 170 rupees. We are still holding. So there is, one way one can see that it is already stressed, but we don't believe so. I think if you look at the valuations here, so it is 1.25 times price to book, which is still much, much cheaper in comparison to many NBFCs in the market. And you look at the funding requirement in the power space now. So previously we were talking more of thermal power, but now renewable as a base is also expanding. So of the overall book of PFC, 25% they are talking about moving into renewables. And that is where ESG funds, which generally nowadays we are not talking about. So that money also moves into those power stocks, which are moving into renewables, whether it is the financing companies to the power. And this is the trigger, I think, going ahead for these companies. Just take the case of Titagarh Wagon, when the whole investment cycle started for where we were talking about railway wagons manufacturing, the stock became 10 times. Then why are we getting shy away with the 3 to 4 times of recovery in the stocks? So when the money flow comes in, right? So last year we saw in 2023, within 6 months, FII flows came in actually in the Indian markets of almost 1.7 lakh crores. And it has not gone into the previous favorites of FIIs. So where this money has gone into, it is also looking at the growth stories in India. So when in the emerging markets, India is growing by 6-7%, that money is also looking for the growth. And that is where when other growth stories are picking up, so liquidity can drive it higher also. Yes, intermediate declines, consolidation, it is part of the game. That's why I use the word 2 years at least, where you need to hold on the positions now.
Okay, Amit, hi, good afternoon. Financials. I mean, at an index level, I think this market is going to find the going tough unless large financials move, right? And that's where the big question mark is right now. You have a lot of holdings, of course. ICICI Bank, I can see SBI as well, and there's BOB as well. what do you make of things that this whole fear around margins? I mean, look at what happened to Bank of India, for instance, today. The stock has just been slammed down despite stable asset quality. So just what is your sense on what we are in for? How long can this confusion and this pain last on banks? And what would you buy, I mean, if you would, in the fall?
So private banks, they are holding a higher chunk actually in Bank Nifty and also in Nifty. So when the money flow is not moving there, and obviously it is not moving over there because of the valuations also. And we need to understand this. And I think the select PSU banks, for example, Bank of Baroda, you mentioned, it is part of our portfolio. You have clearly seen it is outperforming the other lot, right? And it is just crossing, 1% of return on assets. I think that is the key for major PSU banks right now. NPAs are down. NPAs rather are down by almost the 10 years. I think the major kick now, which was somewhat suggested in the budget also, is the private capex. So that why the government has kept from 10 trillion dollars to rupees to almost 11 trillion rupees. So only 1 trillion they have increased because they are also betting on the private capex to start moving higher. In fact, we had seen before that mostly the money was moving from households into real estate, or it was a central government capex. But now the listed corporates have done more than 8.1 trillion rupees of capex in the last 12 months. And that is where I think this corporate lending book of these PSU banks is likely to grow from here, which is hardly 6%. It is not average credit growth of 17% that generally you see, where the RBI also had raised the red flag of unsecured lending higher. And so my sense is, with this corporate lending book growing, which has already started, initially the corporates had a lot of money because they were not doing capex before. Now they are using the internal accruals, and now they are moving into banks. So this is where I think PSU banks, with this volatility, they are going to be major movers. Plus, the Indian bonds, which are going to be included in the JP Morgan bond index from next year, then Bloomberg will follow and Russell afterwards. I think money flow will keep the bond yields lower. That will be the driver for the treasury profits also.
All right. Hi, Amit. Good afternoon. Good to see you. And, Amit, the big one in there is HDFC Bank. And I'm looking at your portfolio. I can't see it in the top 10 holdings. So good on you. I mean, you managed to miss that because the consensus has been do a sip, sip, sip. And all the stock did were dip, dip, dip. But at this valuation, what's your view? Do you think that it's time to take some bit of allocation, or you say, I'd rather stay with an ICICI Bank, some of these PSU banking names that you're talking about? Is HDFC Bank catching your attention or not?
See, the stock has become 13 times from 2008 to 2020. Still, if you want me to carry on those to give those kind of returns, I don't think so. So whenever the new rally starts, it contains its own leaders. And that is what we need to look at, that from where actually the money flow is coming and where to grow in excess of 20%. So that is the opportunities. And that is why the money is divided. So, and that is the reason those valuations are getting derated actually right now. So I understand your point. The levels are good, but we are looking for growth. So even you look at index. So index can remain around 21,000 for some time, but it does not mean that you cannot make money in the equity markets. And I think that is what our focus should be. So even in index, Nifty, you will find some stocks where hardly any weight is there. I see in 2021 when we bought Mahindra, it was hardly 0.5% of weight. Even it got tripled how much impact it had on Nifty returns. You look at NTPC, actually it hardly 0.5% of weight when we bought around 170. So it has moved up, but hardly how much impact on the Nifty. So that is where the India is changing and the markets are changing. I will not be surprised after 10 years, we will have a little different color of the index also.
Right. So, Amit, as of now, HDFC Bank is still not something that meets the criteria as of now, right? It'll be an avoid till now.
Yes.
Okay, got it. But, from the mining and the power space, I think you're looking at some lithium players. What are the stocks? Tell us.
So I think that's a good opportunity. See, this is what I call as materials research. And this is where some capex is moving, whether it is PSUs or some private companies. The companies in India, they are looking for some critical minerals actually outside or materials outside to acquire. If you see recently what has happened, the lithium prices actually have declined. It has declined by almost 70%. Why? Because the Chinese market, which is a very large EV market, there was a slowdown actually there, and that led to the decline in the lithium prices. And if you see the impact on the South American countries like Argentina, So there was a higher inflation impact over there, and then this decline in the lithium prices. So their mines are on block, and that is where Indian companies are looking to purchase. I think this is the next trigger. So you have seen in Jammu and Kashmir, we already saw 5.9 million ton of reserves, lithium reserves coming out. But this is another big leap where companies are moving and they are looking to acquire. I think it's a good time going to be for mining companies. You are seeing the iron ore prices are still lower. The lithium prices are still lower. If you can acquire, and going forward, suppose the dollar depreciates further and these commodities starts moving up, it's a win-win situation for all of these companies actually going forward.
Thank you, Amit, for joining in. Great conversation.